Well, let's be clear about something right up front. I've definitely been wrong about the direction of long-term interest rates. If you look at what's happened over the past year, long-term yields have actually been coming down while long-term bond prices have been going up. I'd like to say I got some of the market right, and I think I have. If you look at shorter term yields like five-year treasuries or 2-year treasuries, there's actually, in the case of the 2-year, been a very sharp move higher with yields tripling off a low base. We've seen 5-year yields that are still well off their 2013 lows. As well as some of the other things that I've looked at, junk bonds, emerging market bonds. Those ETFs have actually lost value over the last couple of years, and so I did get that spot on, as well as the euro currency. But again, let's go back to bonds. What happened and what can turn this thing around? Well, I think the real issue is that while growth overseas has been incredibly weak, or excuse me, while growth here in the US has been incredibly strong or improving, we've seen growth overseas continue to disappoint. So when you get that split with the economy doing poorly overseas, you have very aggressive monetary policy in those countries or regions, Europe, Japan, and so on, and their cutting of interest rates to very low levels, their printing of money is helping to send dollars to the United States, which is holding down our bonds. They're buying bonds, driving yields down and prices up, even though our economy is doing just fine. So again, it goes to what's happening overseas versus what's happening here. We really saw over the last couple of years that foreign economic growth, particularly in Europe, has all but petered out. And you have the European Central Bank doing aggressive quantitative easing. You have some central banks in places like Denmark that are actually, in Switzerland, that are actually pushing short-term interest rates into negative territory. This is the Japanification, if you will, of Europe, where bond yields in Japan have been depressed for years and years. Now that's happening in Europe as well. And as those European yields come down, it becomes a game of relative value. I mean, you and I might look at a 10-year treasury and say, I don't want to earn 1.8%, that's nothing. But it sure as heck beats what you get over in Germany, where a 10-year bond is yielding just 0.36%, or Japan, where it's yielding just 0.37%. So again, you have fixed income investors, people who have to invest in bonds, are buying US treasuries because, relatively speaking, they offer more than you can get in Japan and Germany and France and other countries. So that's giving you this convergence where yields here in the US are converging with overseas yields, despite a US economy that's just moving right along. Well, it's funny, we can continue to get strong economic data here in the US, and we did just get a jobs report that was very strong. We saw, a very strong December reading, a very strong January reading, unemployment being up, but only because more Americans entered the labor force, which is actually a good increase. We just saw average hourly earnings in the US rise at the fastest rate since 2008. So basically, we've seen strong US news, but that's not really what matters for bonds right now. The single biggest driving factor for bond yields would be foreign growth. We have to see growth in Japan, growth in Europe start to pick up, and that, ironically enough, would matter more for US bond yields than better data here. So that's really what we're watching for, and I think we may be seeing signs of that. The turnaround in oil prices, for example, may be signaling a turnaround in investor sentiment about foreign growth. And we've seen Japanese government bond yields actually start to pick up, so not by much, but a little bit. So if that process continues, that's what's going to be all important for US bonds, and that's why you've got to continue to follow what's going on overseas. This is Mike Larson with Money and Markets. Thanks for listening.